York next
Sunday,
week.
Yeah.
Oh, can't wait. Boeing, I've been scaling out of that one. It's been on a decline, and I thought with the news out today, it should have bounced higher. I'm out of the name.
Stock picks and weather forecast. Thanks for watching Fast.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to save you some money. My job is not just to entertain, but to educate, to explain. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Oil will come back down. I don't know if it'll be this weekend, but at some point it's going to pull back because there's just way too much of it. That's why stocks, which started the day off horrendously as oil shot up into the 90s, managed to bounce off their lows, even if the ultimate session was ugly, with the Dow sinking 453 points, S&P shedding 1.33%, and the Nasdaq falling 1.59%. Wall Street's convinced that this move in oil must be ephemeral, or I have to tell you, those numbers would be much, much lower. But with this war, strange things can happen. Iran still seems armed to the teeth with missiles, with drones, and they want to shut down the entire Middle East petroleum complex. That's really what's going on here. It's why oil skyrocketed. It's something that Iran can still do, perhaps with an eye toward, they think at least, pressuring President Trump to stop prosecuting the war. Now, we obviously don't know how long the war will last, though, and oil has a mind of its own. As long as prices stay elevated, any other asset class could be standing on quicksand. When oil goes up, stocks go down. Period. End of story. So let's start our game plan for next week with a recognition that oil's rally was so easy. It just burst right through the 90s that it wouldn't shock me if it went even higher, especially if the shipping companies refused to go through the Strait of Hormuz, even after being offered insurance. You know what? The captains may be willing to risk going through that bottleneck, insuring the cargo, but letting the crew take the brunt of an Iranian attack seems wrong to me. I don't know why. I don't know how many people are going to take that deal. Now, I accept the stranglehold Iran has on the Persian Gulf. If the president were to open the Strategic Petroleum Reserve for a few weeks, then oil could be crushed. Unfortunately, the reserve's at half capacity right now. Maybe not enough to last through the entire conflict if President Trump keeps insisting on Iran's unconditional surrender. Presumably, unless something truly horrific happens over the weekend, though, we'll be back dealing with stocks, looking for those that might be immune to the pain from higher oil and the pump. So let's start with one that I think is. Let's start with Casey's, the shorthand for the 2,900 store chain that lives in so many small towns in America. By the way, their breakfast pizza is fan fave. We tried it. We liked it here. Casey sells gasoline, too, so someone may want to spin that as negative. But I think the crowd will love it when it reports after the close. It's the best chain of stores that nobody on Wall Street has ever heard of or, of course, gone to. Tuesday morning, we get results from Kohl's. And this earnings season has been kind to almost all the retailers. Kohl's, with new management, will most likely be treated well. I like to buy inexpensive quality, and we got some real great numbers from the last few weeks from solid discounters like Burlington. Boy, that was really good. Ross Stores was even better. TJX was strong. I don't know if we actually need Kohl's, but it could be the beginning of a rebuild that's worth watching. After the close, wow, big one. Oracle reports. This one's a total pain point ever since it decided to go all in on building data centers. The plan was hatched back when the stock was in the low 100s. Then it soared to $345 as we learned that Oracle had huge orders to build data centers all over the country, including a gargantuan one from OpenAI. But when Oracle took down a gigantic amount of debt to do the build-out, investors started getting worried, and the stock's now been more than cut in half since then. It's no exaggeration to say that Oracle's the most important company reporting next week. We need to hear that the data center's build-out's going well and the company's starting to make money, or maybe soon. I don't know. I wouldn't mind if they sold that Cerner, that medical records business they bought, even if they got less money than they paid for it. Hey, you know what? Hey, why not get the full skinny on what's really going on at that Oracle mega data center place in that they're doing with OpenAI in Abilene, Texas? A lot of chatter about how OpenAI may not want to do more at that site. I don't know. I want to find out more. I want Oracle to tell me, because I've got to tell you, the story that appeared this afternoon that there might be trouble did knock down all the hyperscalers and all the semis in a beleaguering last hour of trading. I don't know. May not be true. We also hear from AeroVironment, and this one's timely. We have lots of defense stocks just going higher and higher, led by Lockheed Martin. That's big hardware. By the way, I like RTX, too. If you want drones, though, and I know many of you do buy the stock of AeroVironment. It's a longtime Cramer fave. But things don't seem right here. In November of 2024, this company announced a deal to acquire Blue Halo for $4.1 billion to exploit that company's counter-drone technology as well as its satellite abilities. Blue Halo has a big contract with the Pentagon for satellite work. The stock was pummeled recently, though, when we heard that the contract will be rebid. Now we got to find out what's really happening here. I think AeroVironment has terrific technology, but we need to learn more about Blue Halo because without that contract, maybe these guys paid too much for the acquisition and the stock is overvalued. I want to know. Now, one other thought. Howmet, terrific aerospace parts company, gives a presentation about its technology on Tuesday. It seems that almost every time this company speaks, its stock jumps. We joke about how much Howmet is loved, even go as far as to give it a nickname for Howmet, How I Met Your Mother. I think you can own it with a little risk and a lot of love right here. It's just in the sweet spot. Wednesday, all right, consumer price index. I'm wondering, we'll just ignore it because of the oil, the run in oil? I hope not, because some of the key components, insurance, food, rent, they're going lower. It's vital that inflation at least give the appearance that it could go down, or else the Federal Reserve will struggle to justify more rate cuts because of what's happening with oil. I think the economy and the market both need lower rates. Look at today's lackluster employment report. A lower CPI will allow incoming Fed Chief Kevin Warsh to convince voting members that they need to keep cutting rates. I bet we get a soft number. I just don't know if it will matter. The food stocks have been horrendous of late. One of the worst is Campbell's, which has salty snacks, baked goods, and, of course, soups. This darn thing's only worth $7.7 billion now, despite that acquisition of Rayo's, which has been a home run for the company. That 6% yield looks real safe. But the issue, the real sticking point, is that Campbell's earnings are suspected to be down in 2026. And money managers don't like to buy the stocks of companies that are going to have down years. Plain and simple. Thursday, we get reports from three that I like: Dick's, Sporting Goods, Dollar General, and Ulta Beauty. Dick's is on a big winning streak when it comes to the numbers, but not the stock. All this week, though, if a retailer reported a good number, its stock was rewarded. So maybe Dick's can finally blast off. For the same reason, I think you can buy both Dollar General and Ulta Beauty, unless oil makes a quick run to 120. These fit the description of what's working here: bargain offerings, real bargains. They have them. As long as the price of crude doesn't go insane, it will matter, and these will go higher. Finally, on Friday, we got the most important figures for the week. It's called the Personal Consumption Expenditures Data, PCE, which is the Fed's preferred way to measure inflation. Again, we're not able to predict oil, but ex-oil, this one should go for the bulls. Here's the bottom line. It is tough to make judgments about the market when we don't have a clear sense of where this war with Iran is headed and what's going to happen in oil. But we can still make judgments about individual companies. To me, what's amazing is that oil did skyrocket 35% in 1 week. By the way, that was the most in 1 week ever. And yet the market didn't crater. Maybe that, and not the oil premium, is the real takeaway. Let's take calls. Let's go to Bobby in North Carolina. Bobby.
Jim, do you think that parts of Honeywell, after they split, will be better than the whole? If so, why shouldn't I buy? Bobby from the state.
All right, that's a great question. All right, it's a great question. Now, here's the issue. It just moved. It moved huge. And now it's pulling back a little. And I think that you got to let it pull back a little bit more if you want to get involved, because it looks like the stock has had a short-term peak. Both Jeff Marks and I think this company is sensational. We're not selling. We want to own it right into the split. But be aware, it's had a big run, and now those industrials start to come down a little. You get a better price, and then you take it. Let's go to Sandy in Virginia. Sandy.
Hello, Professor Cramer. You're a great teacher.
Oh, thank you, Sandy. I appreciate it.
You're welcome. I've been a club member since its start, and most of my portfolio is terrific club stocks. But I also bought Chipotle when it split in 2024 for about $59 a share. Mm-hmm. It's way down 40% since then. I know you had the CEO on recently and said the stock is getting mighty attractive. So what do you think is happening next?
Well, I've got to tell you, Sandy, the group has gotten very out of favor all of a sudden. It always gets out of favor when the price of the pump goes really high, and that's what this is. That's what this is associated with. The actual Chipotle Mexican Grill is doing better, and at 30 times earnings, with Scott Boatwright really starting to, I think, have a positive impact. I want to buy some here, not sell some. I think it's the right place to be. All right, it's hard, and thank you for the kind words. It's hard to make predictions about the broader market right now because of oil, but we can always give our estimates on individual companies, and we must. Well, Mad Money tonight, volatility has been the name of the game in this market, but global turmoil can lead investors to make moves they may regret. So, here's what we're going to do. We're going to open the phone lines and give Cray-Americans like you the advice you need to protect your portfolio. Then it's lights out and away we go for the new F1 season. But what about for the stock behind the race? I'm taking a closer look at one that I hardly ever talk about, Liberty Media Formula One itself, and giving you my take. And are investors finally buying into Marvell's big promises? I'm digging deeper into the post-earnings reaction. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Oh, boy, I've got to tell you, after a week like this, like the one we just had, where the markets are swinging up and down for a host of reasons, so of course they end up down, some investors can be tempted to make big decisions out of stress or even panic, which, by the way, is not a strategy. So that's why tonight we're doing something different. We're going to open the phone lines and hear directly from you, Cray-Americans. I know you got questions. Hopefully we can get answers. I got to tell you also, this was a week where I felt that it was very unreal, very disconnected to the companies because of the news flow. So let's go to work on both the companies and the market. Now, the first caller up, let's go to Michael in Florida. Michael.
Hey, Jim. It's great to hear you. I've been watching you since 2006 when you first started out. I watch you in the morning. I watch you in the evening. I see you in the morning. Sometimes I listen to David Faber tease you in the morning when you aren't just perfect. But I love watching you. With that said,
thank you, buddy.
Where are we going? Is the Dow? Are we overcorrecting with the Dow? But more specifically, I have a question about energy because everything has been revolving around energy.
Totally
specifically
right.
Chevron and the energy companies in XLE.
Oh, but let me go to work on this, Michael. Let me go to work on this because I got to tell you something. You did hit the key stock in this entire market, and that is Chevron. Why? Because Michael Worth is the best at what he does. You got Mike Worth at the helm. You got the best assets. You got a great yield. You got a solid, rock solid balance sheet. But you now have a high stock price. This has just had a parabolic move, meaning it's a move that goes like this if you were looking at my hand. And what do you do with a parabolic move? You either sell half or sell a quarter. And that's what you're going to do Monday. That is not a criticism of Mike and Chevron. It's what I always advise, and it's almost always right. Sell half or a quarter. The stock has moved too high, too quickly. Jeff in California. Jeff.
Hi, Jim. How are you?
I am well. How about you?
Doing good. My question, Jim, is on the February jobs report that came out today.
Right.
The report showed a loss of 92,000 jobs, where economists were predicting an additional, 50,000 jobs. Last week, Block announced a 40% staff layoff, citing AI efficiency. Morgan Stanley indicated another loss of 2,500 jobs eliminated this week. So what I feel that is happening, companies are now figuring out ways, since they spent billions of dollars on AI, to make their companies run more efficiently. And my concern is that this will carry over for more jobs reports in 2026, the weaker job numbers. So your thoughts on this?
I said the same thing. Thank you, Jeff, for calling. to Kevin Hastert, the absolutely terrific fellow. I like him. I mean, I know these are political guys, so I tend not to praise him, but I like gentlemen, no matter which side. He's a gentleman. And we were trying to hash this out today. I mean, hash it out, no spin. I am a big believer that these jobs, that some of them being lost in particular industries, were indeed what I call secular job loss, meaning that they're lost because of artificial intelligence, because artificial intelligence is doing some jobs better than people can do. And I was saying to Kevin, I hope we have something ready for these people who are laid off. He didn't think necessarily that things, he was talking about productivity and how great for the people who are staying at the job. But I've got to tell you, Jeff, this was it. This was the first time I saw it in the numbers. And as far as I'm concerned, it's the first of many, and it is indeed worrisome. But it can give the Fed a reason to cut rates. And that's good for stocks. How about Chris in California, please, Chris?
Hey, Jim, it's so nice to meet you. Thank you for taking my call.
Of course, Chris. Thanks for calling.
I'll start out with my question.
Sure.
Of course. I have a high-yield savings account earning with a lot of money in it, earning 3.3%. I'm in like mid-60s right now, and I'm looking for the future and what I should do with that money. I currently have a Roth and a brokerage account with Apple, Amazon, Lam, NVIDIA, Broadcom, amongst others that I kind of put all my chips in during the low point of the pandemic, so I've done well with that. And I just wanted your advice on what I might be able to, what I could possibly do with that money in my high yield brokerage account. Savings account, excuse me.
All right. Well, first of all, those stocks are amazing. Really, really terrific. Well done. Well played. But I tell you, I don't want to look. It's a how-to book. I'm not hyping myself. It's a good how-to book. Well, I did dedicate it to my folks. And I've got a terrific chapter, which is just about 8 income producers with growth that are for people like you. Literally. I can't beat what I already wrote. It took a long time to write that chapter. No one really talks about the stuff that I wrote. I don't care. I know that those are the stocks. And that's what people who are in your situation, 50s, 60s, 70s, 80s, that's the list of stocks. That's what I would go for. That's what I'm steering you toward. Alex in Florida. Alex.
Yes, hi. Hello, Jim. Long-time listener, first-time caller.
Oh, great to have you on board.
Love your book, read cover to cover.
Thank you. Thank you.
Have a position in Fermi. Is it buy, hold, or sell?
This is really hard. It's a really speculative stock. And so I'm just going to be really blunt. And I'm going to tell you, I want you to sell it on Monday. Just sell it, okay? I just don't like it. And I always feel so hard. I know that sounds very harsh, but I think it's a loser. Was a loser from the day it came public, even as I like the people who are involved. Ouch. Hey, how about we go to Pamela in Connecticut? I hope we're a little more upbeat. Pamela.
Hi, Jim. Thanks for taking my call. Long-time fan.
Of course.
Can you hear me?
Yes.
Okay, good.
Thank you. Thank you.
So my question, I've listened to you for years and watched and learned and made a bunch of money, so thank you.
Oh, I'm so glad. That's the goal. Look, I make no bones about it. That's what it's about. I'm not trying to rewrite things. I'm not trying to create history. I'm just trying to help you make some money. Let's go to work.
That's right. All right. So my question is around the metals markets.
Okay.
Do you think that gold, silver, and copper are good hedges against my equity positions? And especially wondering about your long-term thoughts on copper.
Okay, look, this is a very tough question, and it usually isn't, because they're no longer hedges. They turned out to be better than the stocks. I am going to be point blank about this. For the last 30 years, I have been what is called a gold bug. I like gold. I do not like silver. It's got too much industrial, and I really don't like copper. I think it's going to be replaced by fiber. But gold, I think up to 10% of gold is just fine. That's what I would shoot for. Anything more than that, and I think you're making too big a bet. Anyway, but thank you for the hey, these callers are great. And I like the upbeat nature of it. I feel bad about the Fermi. Sometimes I just want to say, sure, bye. But you know who I am. I can't do that game. Anyway, thanks to all our callers, and Mad Money is back after the break.
Coming up, with the green flag set to drop on a new Formula One season, is now the time to start a position in the stock behind the world's premier motorsport? Cramer's all revved up. Next.
Tomorrow night, a new season of Formula One racing kicks off with the Australian Grand Prix. And I love talking about any chance to give you the story about the business of Formula One, because this is a publicly traded company. Formula One Group, a subsidiary of Liberty Media, alongside the Atlanta Braves and a host of other sports and entertainment businesses. Liberty Media has an infamously complex corporate structure, something that has kept me from being as enthusiastic as I should be or even talking about it to you. But they've historically had tracking stocks for their subsidiaries that give you something like a pure play on niche businesses like this one. Liberty Formula One represents ownership of the Formula One Auto Racing League, MotoGP for Grand Prix motorcycle racing, and a bunch of minority investments in a grab bag of different things. If you want to own this one, there are 3 classes of stock that I'm going to recommend: the Series C, as in Charlie shares, which trade under this ticker FWONK. I call it FWONK because they have the most liquidity. These Liberty Formula One shares began trading about 2.5 years ago in August of 2023, and for a while, this was an excellent growth stock. Once it found its footing in late 2023, it rallied from the low 60s to a high of 109 in early October of last year. Since then, though, stocks pulled back 23% to $83 and change. And you know what? At $83 and change, I think it's a terrific buying opportunity. Why? Okay, let's start with the numbers. In late February, Formula One reported a strong quarter. For Formula One racing itself, they had 14% revenue growth, 20% growth in operating income before depreciation and amortization, which is their preferred profitability metric. Fan attendance up 4% year over year. Live viewership up 21%. For the broader business, the numbers are even better. Revenue grew 23% year over year, and adjusted operating income became, before depreciation and amortization, that jumped 38%. Then again, that's not entirely organic, though. Last year, Formula One acquired that MotoGP I mentioned, giving them a big motorcycle racing business. I think the numbers look pretty darn good here, though, and I trust Liberty Media's judgment when it comes to acquisitions. Last year's results also reflect some one-time boost from the release of F1, the movie, with Brad Pitt. Either way, though, this is a growth business. Sponsorship revenue grew thanks to revenue from new sponsors, contractual increases from existing sponsors, and an uptick in digital advertising revenue. Race promotion revenue was up too, thanks to higher fees, and media rights revenues also increased. Say, speaking of media rights, in the United States, Formula One racing, it's moving from ESPN to Apple TV. Now, the move was announced last fall. Apple's reportedly paying them about $140 million per year for the rights, whereas ESPN was probably, I think, paying them only about $85 million a year. Oddly, the announcement of this new, more lucrative deal for Formula One's TV rights came at around the same time the stock peaked in October of last year. Now, some of that's because a new TV deal with somebody was widely anticipated, so there was this kind of buy the rumor, sell the news effect. But now the stock's much lower, just as the new Apple TV money is about to start flowing in. Of course, the move to Apple does come with some risk for Formula One. Let's talk about this. As a standard cable channel, ESPN has a wider reach than, say, Apple TV. So there's a realistic chance that the overall viewership might suffer, right? In theory, that could hurt sponsorship revenue down the line. But business-wise, since with Apple paying a heck of a lot more for the rights, I don't see how Formula One could have turned them down. This is one of Apple's TV's biggest bets yet in live sports, so I have to believe that they put significant resources behind it. In fact, after a couple of practice sessions in Australia, we're already seeing some positive reviews of the Apple TV broadcast. There are a couple more reasons to like Formula One, too, although they're a bit in the weeds. First, in December, Liberty Media split off Liberty Live Holdings as a separate publicly traded company, something it had previously done with the Atlanta Braves organization. Now, this is a complicated restructuring move behind the scenes for the corporate parent. But the result is an incrementally more streamlined structure for the Formula One business. Liberty Media no longer has a tracking stock structure after that move. And the company also sent Liberty Live off with some assets that had previously been classified under the Formula One business. The bottom line is that the business you are now buying when you buy F1 is now much closer to a pure play on the Formula One and MotoGP racing leagues. Second, Formula One reached a deal with all the various teams that make up the league, as well as FIA, the league's governing body, through 2030. This is a bit of a formality. It's in everyone's interest, right, to keep the show going. But for shareholders, it represented the removal of an overhang here. Last week, following the company's earnings report, analysts at Wells Fargo upgraded Formula One Group from underweight to equal weight, while raising the price target slightly from 93 to 95. Now, the analysts had initiated coverage with an underweight sell rating about a year earlier, but said that they were upgrading now because their biggest concern, the league negotiations, would be tricky and the new TV deal would underwhelm, no longer seemed to apply. Seeing Wells Fargo basically cover its short, so to speak, on Formula One was pretty encouraging because they've been the biggest sell-side bear on the stock, which has 13 buy ratings and 4 holds. In fact, even after raising its price target to $95, Wells still has the lowest price target for this thing. Everyone else, even the few analysts with holds, well, they have price targets north of 100. Finally, valuation-wise, I won't lie to you, Formula One's not cheap. It's expensive, trading around 42 times this year's earnings estimates. But I'm willing to pay up for this stock because it's got an incredibly unique business. In fact, I would argue that Formula One deserves a premium just for its scarcity value alone. Plus, if you look back to where the stock started trading about 2.5 years ago, this is actually the cheapest it's ever been on a PE or price earnings basis. So here's the bottom line. This weekend, a new season of Formula One racing begins on Apple TV. But as you watch the action on the track, maybe consider opening a new position in Formula One shares. This is one of the few business opportunities in pro sports that you can participate in directly. Stock's been a good long-term performer, but after its recent pullback over the past 5 months, I think you're getting an amazing opportunity to make some real money. Let's go to Bobo in North Dakota. Bobo.
Jimmy Chill, how you been doing, man? Welcome back.
I'm trying to chill. Bobo, I'm trying to chill. It ain't easy. How can I help you?
With a lot of new releases coming out and a big one in the future with GTA 6, now a good time to upgrade a position in Take-Two Interactive?
Bobo, no. It's a great time. I think you've got to get in before GTA, and I've been working a lot on this. And I am absolutely convinced that this recent dip, I wish I'd been able to push it more under 200. It works. I want you to buy some here, and then if it goes below 200, pull the trigger on the rest. You are right to come in. I think this is a great level. Thank you for asking me about it. Tom in New York. Tom.
Hi, Jim. Great big view to you, bud.
Oh, man, it's great that you called, Tom. Thank you. Let's go to work together.
Yeah, so I was just calling on Kraft Heinz and see what your thoughts are.
I'm sorry?
I was just calling on Kraft Heinz to see what your thoughts were.
Oh, Kraft Heinz, man, I got to tell you, as much as I like the CEO, as much as I think that he's going to try to do the most out of it, I can't get behind it. And the reason I can't get behind it is because it has no growth. And I'm trying to stay away from the companies that have no growth, but just good yield, because it just doesn't make up for it. So I'm sorry. I wish I could be more positive, because I got to tell you, Steve Kale-Lane has done a great job. Remember, he did the big Kellogg breakup, and it worked. Maybe you can do something here, but let's give him a chance. As you watch the action on the F1 track this weekend, I'd also consider a position in the stock, Liberty Formula One, F1. I think you're getting a terrific opportunity here to buy. Now, much more mad money, including my deep dive into Marvell. After the chipmaker's latest earnings, are investors finally on board with the mission? I'm giving you my signal. Then, rising oil prices have shaken the markets, but the worries we had last week are still here. I'm telling you what I'm watching in this darn private credit market and why it matters. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Look at this incredible run in Marvell Technology, the maker of custom semiconductors and network equipment. Geez, on an otherwise completely awful, horrible day, Marvell shot up over 18%, breaking out of a 3-month downtrend thanks to a phenomenal quarter. Now, this is one of those cases where I get to say I told you so, because I've been a gigantic fan of Marvell for ages. These guys partner with big tech companies to help them engineer custom chips, the best example being their long-standing partnership with Amazon to build the custom processors that Amazon Web Services uses for lower-cost AI model training. Now, this is a stock that really should have been in the sweet spot. The closest comparison to what Marvell does is Broadcom. They build similar chips for Google. But while Broadcom's been a huge winner in the AI era, up nearly 500% since the beginning of 2023, Marvell's only rallied about 140% over the same period. And that includes today's spectacular run. And look, initially it was doing very well, but it got hit with a nasty decline early last year. Stock fell more than 50% in less than 3 months, largely thanks to a softer than expected quarter last March. But that turned out to be a terrific buying opportunity. Marvell spent the rest of the year working its way higher, fueled by a series of strong quarters. It peaked at $102 in early December, right after the company reported an amazing set of numbers. But those gains were short-lived. About a week later, we started seeing media reports speculating that Marvell was set to lose some of its lucrative Amazon business. That seemed to really upset management. And you can believe that why, if it wasn't true, that sure should upset him. So listen to this. CEO Matt Murphy came here. He came with Mad Money and explicitly said that they hadn't lost any business. Listen to this.
There's all this noise out there. I am the signal. I know what's going on. I have the visibility. I have the relationship with these customers. And so our business is rock solid in our data center.
Right.
And nothing has changed since last Tuesday.
Totally true. Absolutely true. Hope you listen to it. Unfortunately, that impassioned appeal wasn't enough to prop up the stock, and Marvell's stock sank all the way to $70 at its lows roughly a month ago. Look, even as recently as last night, it had only bounced to $75 and change. It started to feel like maybe some people felt that Matt wasn't the signal. In retrospect, though, that was an amazing entry point because when Marvell reported last night, it was, oh my God, it was enough to send the stock into the stratosphere. Now, look, the actual quarter results were solid, clean top and bottom line beat, 22% revenue growth year over year, steady gross margins, and a 1 cent earnings beat off a 79-cent basis. Great, but not really great. Obviously not enough to send the stock up 18% in a single session. There had to be something else, right? Yes. Today, Marvell traded like you caught a takeover bid, and it's all because of the guidance. For the current quarter, management's projecting 27% revenue growth, much higher than anyone was expecting, and a serious acceleration from the previous quarter. The earnings outlook was also very strong. Oh, my God, it was such a good conference call. But what really mattered was everything management had to say about the future on that call. Forget the acceleration in the first quarter. CEO Matt Murphy said he expects revenue growth to accelerate in each quarter of its fiscal 2027, their current year, with Marvell exiting this period at more than $3 billion. That's up big from the $2.22 billion number last quarter. That's an amazing move up. Look, Murphy's also saying that Marvell's bookings are growing at a record pace and that last year their design wins hit an all-time high. This company has a lot of visibility into the future, and what they're saying is incredibly bullish. For the full 2027 fiscal year, Marvell now expects its revenue to grow more than 30% year over year, coming close to $11 billion. Wall Street was looking for something closer to $10 billion. The strength here is coming from Marvell's data center business, which they see growing at a 40% clip for the full year, with their interconnect business up more than 50%. This is essentially the plumbing of the AI data center. Think chips and optical components that move massive amounts of data between GPUs, servers, and the entire data centers. Every time NVIDIA comes out with a new ultra-high-end GPU, buyers need much more higher data throughput to keep the chips fully utilized. Marvell supplies the connections. It's really at the heart of the issue of what a data center does. There's a reason that NVIDIA just invested $2 billion apiece in a pair of networking companies, Lumentum and Coherent. These companies mostly make optical components, while Marvell supplies the networking silicon and digital signal processor chips. But it's all part of the same food chain. In fact, they expect to supply this stuff to all 5 of the major American hyperscalers this year, which shows you just how essential Marvell Tech has become. Marvell's custom processor business is the other major piece of the pie. It reached $1.5 billion last year, more than doubling versus the prior year, and management now expects that business to grow over 20% in fiscal 2027, thanks to their work with Amazon Web Services. Marvell did say that it expects most of the growth to come in the second half of the year, tied to a next-generation ramp in these processors. Murphy also said that the company has firm volume requirements for all of fiscal 2028, meaning 2027 going by the regular calendar year, as part of a new XPU program. I'm hearing lots of speculation that they're working with Microsoft. Then there's what's called the XPU attach, meaning the networking equipment that gets sold along with these custom chips. That business is expected to do more than double this year. Looking further ahead, Marvell said that it expects its data center revenue to grow at a close to a 50% clip next year. Now, that's insanely strong medium-term forecast. But they can make that prediction because so many of these orders are already in hand. In total, management now sees Marvell reaching about $15 billion in revenue next year, while they earn more than $5 per share. So on next year's projections, this stock's selling for less than 18 times earnings. That's pretty cheap, even after today's spectacular run. So let me give you the bottom line here. This was not just a good quarter for Marvell Tech. It was a quarter where management made a much more credible case that its AI-related revenue base is simply exploding. And it was a slap in the face to everyone who tried to claim that Marvell was losing business a week after they reported the previous quarter in December. Now these guys just have to deliver. But when you look at how the stock rallied today, clearly buyers have a lot of confidence in these forecasts. I don't blame them. I'm a believer, too. And I bet Marvell's got much more upside. I think the negatives were really just noise at best and perhaps dissembling at worst. Matt Murphy proved that he truly is the signal, and he proved that his company is crushing it. That money's back after the break.
Coming up, you've got questions, Cramer's got the answers. Get charged up for a fast fire lightning round. Next.
It is time. It's time for the lightning round. Chris, very bad for gold. See, the stock says buy, sell, sell, just cleared another caller stock question. That my step is going to be. You play this out. And then the lightning round is over. Are you ready? Ski, tag, tell the random. Let's go with Phil in North Carolina. Phil.
Jim, how you doing today, Jim?
Well, long day, Phil, but let's try to finish strong.
Yes. I'm fair to Midland today, Jim. You know me, fair to Midland. But I do want to...
Understood.
I want to speak to you about a stock that it's a speculative stock, okay? Doesn't get much airtime. AI speculative kind of thing. Doesn't have, it loses money. Everything that you say not to go into, okay? Recently had a 1 for 10 reverse split. Okay? Tell me about it, because I like it. I own it for a while. I'm up about $6,000. What should I do? BNAI.
Brand engagement. Oh, very small stock. Now, let's do this. This can be your one speculation. And how to make money anymore, I say you can have one speculation. Let it be this one. But it is pure spec. And I've got to tell you, it would not be my cup of tea. Let's go to Sam in Massachusetts. Sam.
Mr. Cramer, I appreciate you so much. My girlfriend loves the show. I'm just calling about Astera Labs.
Oh, my God, this is such a red-hot stock. It's incredible. The price-earnings multiple is high. I always look at it and I say, when is this stock going to come in for sale? And it really doesn't. And that is because it's a very good company. Let's go to Karen in Kansas. Karen.
Good evening, Jim.
Good evening,
this is Karen. I'm a new and very happy Investing Club member, I have to say.
Thank you. Thank you very much.
I would like to know if my stock is a buy, and if not, what do you suggest? The stock is ACOM.
Yeah, they didn't have a good quarter. It's a good company, but they did not have a good quarter. And if you're going to be in that group, you want to be in quant. You want to be in a company called PWR. Okay, that's the symbol. It's called Quanta Services. It is a very, very good company. It's same business, better run. Let's go to Jeffrey in Massachusetts. Jeffrey.
Hola, Jim, and a big booyah to ya.
Well, right back at you there. What's going on, partner?
Not much, buddy. What do you think about Duolingo?
You know, the quarter was bad. I mean, just flat out bad. And so I have no reason to recommend it because I don't have any good numbers for it. It can bounce, but it won't be anything that I think is going to be worthwhile. Let's go to Mark in California. Mark. Mark? Hi, Mark, it's Jim.
Jim.
What's up?
I'm following you for the last 3 years.
No, I'm having trouble hearing Mark. Okay, I'm going to have to go to another caller. Let's go to Marcia in Washington. Marcia.
Hi, Jim. I've been reading your book so I can do better research going forward, so thank you.
Thank you. That's what it's about, learning how to be a good investor. It's a how-to book, and I think that people don't write those because I am a service dog, always have been. How can I help?
Okay, my stock today is Kinder Morgan.
Well, Kinder Morgan is a winner. Now it's a parabolic move. It's straight up, and I always try to tell people that doesn't mean that I don't like the company. It means that the stock is too hot, so we have to do some selling. And that, ladies and gentlemen, conclusion of the Lightning Round.
Coming up, the price of oil may still be climbing amid the war in the Middle East, but Cramer thinks there is a bigger danger to the market being overlooked. He'll reveal it next.
This might sound crazy given the spike in crude this week, but my biggest worry in this market isn't oil. I've heard the Jeremiahs are the pessimists, that the price of crude can easily go to $150. And I say to myself that at that price, Middle Eastern oil will come to the market by hook or by crook. Putting aside whether Iran can even hold out that long, at $150, the Gulf states will drag barrels of oil across the desert by camel if they have to. That's why I'm not too concerned about oil staying sky high. I am much more worried about the abstruse world of private credit. This is where non-bank investment houses wrap loans together and sold them in a package, many times to individuals. Those individuals tended to minimize the risk in their own minds because they love the higher yield that these packages provided them. They also accepted, or at least should have expected, that they wouldn't be able to get their money out easily because these private credit funds are meant to be long-term investments. That was very clear. Then again, the investors never thought they'd want to pull their money out of these funds overnight because they seem safe and certain, and some of them really are. Most of these firms offer small windows, monthly or maybe quarterly, where people can get their money back through a repurchase of their shares. Suddenly, though, with the now endless drumbeat that these loans they own could go bad, a lot more people want out. They can get out without crushing those who remain. Now, we saw this at one Blue Owl fund, which blocked the redemptions of its fund. Although they did come up with a novel way to return some capital to everybody, involving the sale of some of the loans. We saw with Blackstone, where they chose not to limit the redemptions when they exceeded 5%, but employees had to dip into their own pockets to help. Honorable, but a reminder that individuals may not be the right customers for these wraparounds. Now we've learned that BlackRock is getting overwhelmed with redemptions for its huge HPS corporate lending fund. 9.3% went out, but they're only willing to repurchase 5%, so you won't be getting your money back, at least not all of it. This HPS situation is much less fraught than the others. This particular fund's given you near 11% in income for each of the last 4 years. Still, that return is going to be dented by the people who went out if there are too many of them that are let out. Just not enough liquidity for big departures. The fund's not really set up to handle them. And again, rapid, large-scale departures can't be handled without knocking back the portfolios because of a lack of liquidity. Last night, when I was talking with Lloyd Blankfein about his new book, Streetwise, the former Goldman Sachs CEO questioned what's really going on with these funds. We're in a fabulous time for investing, he reminded us, with a strong economy. Yet, very strangely, these companies have done very little selling of their own businesses. It's a real head-scratcher. It got me to thinking that maybe the stuff they bought, their portfolio companies, just aren't up to snuff, given that the market is really just a few percentage points from its all-time highs. Lloyd said these private equity and private credit firms should have been selling assets at terrific prices, but the opportunities never seem to materialize. Now they may just have to take what they can get, and I totally agree with that. The managers, however, seem unwilling to take the hit. They tend to be optimistic, maybe overly optimistic, and believe that everything will work out. But, man, if you can't unload these businesses or loans to these businesses in such a terrific environment, at least when you consider how the average have done in these last few years, well, when are you going to sell? That's the real problem here. The redemptions are just a symptom. Many of these types of funds seem to own equity or loans in companies that are simply not wanted, especially the stakes, in overly large stakes, I should add, in enterprise software. Maybe the fault is in the portfolios, not just the individuals who went out. Perhaps there's a huge amount of whistling past the graveyard. Unfortunately, there are hundreds of billions of dollars involved in these kinds of funds, and as long as we're worried about enterprise software, you're going to keep hearing about the problem. Now, because of the way these private funds are set up, there can't be anything like a bank run. But the private credit issue and the banning of some redemptions erodes the confidence in the markets. Looking back, these funds perhaps should never have been marketed to individual investors who didn't understand the risk clearly. If things go south from here, private credit and not oil will be the focus, and it won't be a positive one. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here in Mad Money. I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC or its parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and/or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.